Welcome to Stock Watch with me, Ntauleng Lechela. Joining me to unpack your stock-related questions today are Jean Pierre Verster from Protea Capital Management and Drikus Combrinck from Capicraft. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392, or on X at Business Day TV using the hashtag StockWatch. Gents, thanks so much for your time this evening. Volatility remains the name of the game, Drikus, with President Trump doubling down on his tariff threats and EU counterparts looking to retaliate. Let's start there. The impact this could have on supply chains, how this could also nullify that EU-US trade deal that was reached last year.
Yeah, sure. We've got some flashbacks of April last year, right? It's only not that severe, and there's this underlying suspicion that Trump will back down again once some kind of compromise is shown on the other side. That's all a negotiating tactic. So how serious is he about Greenland? I think the US would like to have Greenland under their control. They're very serious about that. Would they, how far are they, how far is Trump even going to go to get it? Not that far. Even him, I don't think he's going to destroy the alliances that there still is between the US and NATO. I do think, however, that this is a big wake-up call for Europe. And then whichever political side takes the reins of Europe, be it the pro-nationalistic side or the pro-Brussels European Union type of side, going forward, I think Europe needs to reindustrialize, and they've already started rearming. So, Europe taking control of their own future, I think, is a good thing, and I think even a bullish thing for Europe and for the global economy.
A case of deja vu there, JP. There's also the issue around the legality of Trump's tariffs, with that case being heard at the Supreme Court. With that still in play, how are you viewing the tariff risks, right? I mean, one day we could wake up and be told, hey, these tariffs are illegal.
Exactly. So it's very difficult to price it into markets because of the uncertainty, not just the uncertainty of decisions of the past and whether they will be implemented or will be allowed to be implemented, but then also decisions going forward. So there's a lot of uncertainty. For most companies, if you think about it in a year or two from now, they would have adapted. If you think about French luxury goods companies that are squarely in the crosshairs of this potential tariff from Europe and exporting luxury goods from France, in the short term, they might take a bit of a knock on the share price, but over a year or two, they'll just increase their prices and they'll offset it. And on the margin, maybe demand decreases a little bit, but not too much. So companies have got levers to pull to adjust when it comes to political influences. And like we saw in April last year, the mistake one can make is to overreact and to try to reposition your whole portfolio based on these decisions that politicians make. And on a whim, they change their mind, or, as you say, the courts get involved, and then you need to reposition again. So the default should be stick with your long-term plan with the good companies you have in your portfolio, and you need to think very carefully before you throw them out or make big changes just because of knee-jerk reactions or decisions made by politicians.
And talking about those knee-jerk reactions, I saw that LVMH down 2%. So not much of a difference. We can see that traders aren't fretting as much. But Drikus, there you mentioned, rotation out, not necessarily rotation out of the US, but what we're seeing right now at play, and that could be, of course, beneficial to Europe as it gets its ducks in a row. When we do see such high levels of volatility, we usually get questions around portfolio management and buying the dips. JP also touching on that. This time around, there's a question on rotation into emerging markets. I have shifted my portfolio to around 60% EMs versus USA S&P 500 base. From what I gather and read, over the next 5 years, EMs will beat classic S&P 500. SA Inc. also being part of this EM makeup. Is this a fair thesis, Drikus?
Yeah, I lean in that direction as well. You know, I think EM will outperform, let's say, from a starting position on the 20th of January 2026, looking out 3 years or 5 years. I think EM should outperform the US from these levels over a fairly, let's say, the medium term. But I do think 60% of your portfolio in EM is quite a statement.
Yeah.
I wouldn't go that far. We're also bullish on the EM market, certain EM markets, not all of them. I'm very careful of China. China is in a depression. They're trying to get the consumer out of that depression. It's only the supply side and exports that's growing, basically. Consumers really struggling, consumer sentiments down in the dumps. But they are dumping a lot of cheap stuff on other emerging markets. So the inflation impetus for those markets are very low. We've got a weaker dollar policy from the Trump administration, lower interest rates. Those feed into stronger emerging markets and stronger emerging market flows. So I think the environment is still very conducive to emerging markets, even though they've outperformed last year. So yeah, I think emerging markets, hard assets, somewhere maybe this year there will be a big shift back again to the US. If something or the other happens, one is always blindsided by these events. But if the boat tilts too far towards the EMs, what I think it will do somewhere along this year, or to hard assets like precious metals, which are running at the moment, then you have a snapback to US assets. So be careful for that. If you are still underweight emerging markets, you might want to wait for such a buying opportunity. But I wouldn't go so far as putting 60% of my total portfolio into emerging market equities.
So quite a statement over there, 60% in EMs, JP. Let's get your take on that in terms of, asset allocation spread across region, as of course we've seen the dollar continue to weaken and the rotation out of US markets. Not completely though. We do know that those tech stocks are still doing well.
Yes, it's a tricky one when you speak about asset allocation and geographic allocation, because where a company is listed is not necessarily where it makes its money. Even when you look at these large constituents of US indices, many of these companies make as much money outside of the US as they do in the US. So they themselves have got significant exposure to emerging markets and emerging market currencies. So think about Apple, for instance, or Meta. Alphabet. These are international companies. They might be listed in the US, but they are not US companies in terms of where they make all their profits. So a lot of people already have a natural level of diversification in their portfolios, which they might not even recognize.
Yeah.
The same with if you have a South African portfolio. If you own the top 40 index, most of the profits are not made in South Africa. Your portfolio is actually majority exposed to non-South African sources of earnings. So I wouldn't try to be too cute when it comes to changing my portfolio too much in terms of having exposures to shares and where they might be listed. I would just buy the strong companies. I mean, the biggest company in emerging markets is TSMC, the one semiconductor manufacturing company. And that's all about chips for US companies that they buy from TSMC. And therefore, you can actually say it's got more exposure to what's happening in the US and the AI war on I'm looking for a word. It's the arms race, the AI arms race, than any other US company even. So sleep well if you've got a well-diversified portfolio with the shares of strong companies in there.
And we're talking emerging markets. A question here around Tencent. Of course, a Chinese tech company. Why has the company share price been going down the last month or so? Anything to be concerned about, JP?
Month is a very short space of time. As Drikus has referred to as well, the latest data coming out of China is not positive.
Yeah.
Tencent is exposed to the Chinese consumer. The the Chinese stocks in general have been under pressure this last month. From a South African perspective, the rand has strengthened. So if you're looking at Tencent in rands, then they would also be lower. But over the last year, Tencent has done very well. And it's still in a very good position for the long term looking forward, with very good diversification, again, internationally, through all the stakes they have in international gaming companies. So I'm still comfortable with Tencent in a portfolio, and we still hold it in our portfolios.
Yeah, and there's a similar... Yes.
I might want to add about China is that they're spending 10% of GDP at the moment, at the fiscal level. So that will filter through in some ways to the consumer. And they've just announced this morning again a whole slew of new measures to prop up the consumer. So they might find some way or the other, after the umpteenth regulation or policy, that they might at last, get a consumer that's buoyant. They need to rebalance that economy towards the consumer. That'll make the whole globe happy. China is actually dumping its internal balances on the rest of the world. It's running $100 billion surplus per month. That money needs to go somewhere, and the cheap goods that they're not selling at home must go somewhere. So they're making their problem everybody else's problem. For some, it's not a problem. We're buying cheaper Chinese cars here. So for now, it's a positive for us.
There's a similar question around that 10-cent share price, with a viewer asking about Prosus. And, I assume it's on the back of what we've been seeing in 10-cent, Drikus.
Yeah, and it's basically the same. It's only a few other interests bundled together, but it's basically driven by Tencent. There's also, I'm not sure, I don't follow it quite as closely, Jean Pierre, maybe you can add to that. Naspers has disappointed with the share buyback just a few weeks ago. So I think that's part of why Naspers is underperforming.
All right, getting straight into those questions. Netflix has revised its offer for Warner Brothers Discovery, offering all cash instead of a mixture of cash and stock. JP, will this be enough to fend off Paramount?
I think so. It'll be interesting to see how Paramount responds. There is in this newer provision also a do not shop provision, which means that Netflix are trying to bind Warner Brothers, that they don't go back to Paramount and say, hey guys, let's talk. So it all depends on also what Paramount decides to do. If they want to up their bid of $30, the Ellisons have taken a bit of a knock because the Oracle share price is sharply lower the last few months. So the capacity to increase the bid has been hit a bit. But I would say the probability is still that Netflix probably has got a 70% probability to win this fight.
The news, JP, also coming just hours before the release of its fourth quarter results. Reflecting on Q3, I think they did miss on earnings. Your expectations when it comes to those numbers, considering it's also a quarter that lies in between the festive season and everyone's at home watching a movie,
Yeah, so we'll hear tonight, Tuesday night, probably around 10 or 11 p.m. from Netflix. And as usual, they don't give guidance. So the expectation is a bit tricky to have regarding the share. And that's why Netflix has got a tendency to react quite sharply, depending on the numbers. But I would say the fact they increase the bid today gives one confidence that they have confidence that their cash flows have been strong. So I think that's a little hint that the results could be quite strong tonight.
Let's move over to a local counter, Master Drilling. A question here. The share has been moving like a yo-yo. Is there a reason behind this? Of course, that group has been benefiting from, I guess, a buoyant commodities market, strong order book as well. Drikus, I'll give that one to you.
Yeah, sure. So we followed Master Drill for some while now. I think it's the only company to be ever listed that's based in Fochville. But they're completely a global company. They're operating all over, but I think the biggest customers sit in the precious metals industry, especially the gold industry. So if the gold price stays here, I'm sure more holes will be dug, and they will be helping to dig those holes, or just, getting air to the shafts. They do raise bore drilling predominantly. And deep level mining is their game. The problem is the last few years is a lot of the resources, offshore has gone to open pit mining. People prefer open pit mining. It's much less, much more cost effective, less risky, etc. But there are some deep level mines, and as the bull market progresses and as those other mines age, they will need to sink shafts, and that's where master drill will come in. And if you've got time on your hands, I think this one will perform somewhere in the future. I think part of the reason why it's so choppy, well, liquidity firstly, but secondly is they've disappointed quite a bit over the last few years. They just don't seem to get the some forward momentum. They just don't seem to get what you might call escape velocity, some momentum behind the earnings. Once they do, I think this one will re-rate. It's a global company. It's a quality operator. Let's see. Only problem, it is capital intensive, and that's the only question marks around the business that I continue to monitor.
Do you share the same sentiments, JP? Drikus there, of course, mentioning that bull market, and if it continues, of course, the likes of a master drilling likely to gain.
Yes, it's still my favorite company from Vogtwal. And the only issue
is it not the only company?
Indeed, you got me there. So yes. So the illiquidity is a problem, so it won't find its way into most institutional investors' portfolios. But it's a decent company. So no, if I see it in a portfolio, I would leave it alone. And I do think also that at the cheap valuation, the outlook looks quite decent for them.
And sticking with that theme around mining, Raubex in the meantime is looking to sell all or parts of Bauba resources. A strategic reset of some sorts there that'll shift its core back to infrastructure if, of course, that plan comes to fruition. Is it a good move? Yes, it could unlock capital, but miners in general, bemoaning conditions, including things like higher energy costs, Drikus.
Yeah, so, the construction sector has been a minefield, and I think sentiment is bombed out. I do like bombed out sectors. If everybody's left the room, or you go to a conference and there's 70% of the seats are open. I like those industries where the convention is basically, the skeleton staff pitching up or the juniors pitching up. And I do think the construction sector is there at the moment, after, a few tumultuous years. And the Raubex itself might dispose and reorientate itself. I think that's a good move. They might receive a few bucks for Beaumont. But I do also think that they've pitched for a few big contracts. If those comes true, they might have a good year, starting from a low valuation. There's a lot less competition around. I do like the setup.
And your take around the construction sector, we can even look at, I guess, the building materials operators, the likes of a Cash Build.
Yes, so I think Drikus made a very important point regarding bombed out shares. And when shares, typically when companies have got cyclicality and a share reaches near the end or the bottom of the cycle, it becomes very interesting. And even a company that over time, the share price might go sideways. If sideways means sharply up and sharply down, there's an opportunity. And one of the things that I've been trying to do is improve my own process by being more aware of the cyclicality when it comes to share price movements. So the cyclicality in materials, building materials. And yes, there's also cyclicality in retail. A company like Cash Build has also exhibited cyclicality, especially since COVID.
Yeah.
That's where they went sharply up when everyone was improving their homes. It went sharply down after that. It had a little bit of a bounce up again, and then it came to new lows in the last few months. So I think it's another one which effectively is bombed out and looks very interesting because they've got a very wide network. The P&L hardware acquisition was not good. They wrote off a few 100 million rand, but the balance sheet is clean now. And the only concern is the strength of the rand, meaning there's deflation in the retail sector. Deflation is not good for retailers. So maybe not immediately, but it's another bombed out share that if you think out 1 to 2 years and longer, then it's definitely an interesting one to watch.
And sticking with the theme around retail, Drikus, a lot of chatter about that Mr. Price bid for NKD. Investors don't seem to like it. And, you know, going on history, right? Clothing retailers haven't fared well internationally. Your reading of that deal and, you know, the chatter around Mr. Price probably paying too much for it.
Oh, so I do think so. We don't own any shares as a caveat, but I do understand the frustration of the current shareholders. If you read those those letters directed to the company, to the board, you'll see that unhappy is quite the euphemism. I think they're furious, and you can see it in the share price. Yeah, and we do know that retailers, especially when they buy offshore assets, they've hit a few landmines. I can think of Woolies and Pepco is struggling a bit in Brazil now. I'm not sure what's going to happen there. The jury is still out. I remember Pick n Pay going into Australia, and Choppy's coming into SA, etc. Investors in SA has gotten weary of companies making big acquisitions in the retail sector in this market.
So
for good reason.
Yeah, so if history, if we have to go by history, of course, that acquisition, the concerns around that acquisition, right, really warranted. Let's just get your take on that deal quickly, JP. Does this plan to expand abroad suggest Mr. Price is perhaps maybe less confident about prospects in SA, maybe a hedge against those local risks?
Potentially, or one can say that it's the management incentives that's making them do this, because it's been a few reporting periods now that I've been uneasy, because the first slide you normally see is about wanting to be the biggest, not the best returns, wanting to be the biggest and having targets for things like revenue. Now that's quite silly, because bigger is not always better. It doesn't mean better share returns. So that made me uneasy the last few reporting periods. And that could be a reason why they did that, because the management incentives are not what they should be. It's not focused on profitability. So the management team now has everything to play for. The pressure is on them. They'll probably continue with the acquisition, because otherwise there'll be probably some penalties to pay. But in a year or two from now, that's where we're going to see the chickens coming home to roost. And either the management team will be vindicated, or then I expect the CEO to fall on his sword. So we'll see the end chapter of the story in a year or two.
Yeah, an interesting watch to watch over the next year or so. Let's get your stock pick then, JP. Where do you see value at the moment?
I see value in the small country of Georgia. And one of the two major banks there, TBC Bank Group. I chose it a year ago. I went to look, time flies. And it's done very well in the past year, and I expect it to continue to do well. It's one of two banks that have got a dominant position in Georgia, and that's where they make 90% of their profits. But 10% of their profits is made in a newer division that they launched in Uzbekistan, a fintech bank, no branches, all on an app. And Uzbekistan has got 10 times the population of Georgia. So if they get that right, and they are busy getting it right, then the Uzbekistan business can be bigger than the Georgia business. So it's in a part of the world, not too far away from Russia, that people feel nervous about. That's potentially why the shares are so cheap, but that creates an opportunity. So we own TBC Bank Group shares. We don't think there'll be too much turmoil for Georgia and Uzbekistan from what's happening in the Ukraine. And we think that longer term, it's an excellent management team with a very good proposition in these two countries.
What about you, Drikus? Are you also going offshore?
No, it's actually locally listed, going hard assets, but of a different kind. It's ETF RHO. That's a rhodium ETF, only one of two. There's basically no other above ground rhodium stocks on the planet. The OEMs haven't really stocked them. They did in 2022, and the price spiked a few 100%. We're up quite a bit already, but we're still about 150% away from the 2022 high point. About 90% comes from a few mines on the western limb of the Bushveld complex. So supply is very constrained. And if one of those mines, for instance, goes through a seam with very little rhodium, then rhodium supply drops by 10 or 20%. So it's quite a interesting metal. It's much more width from a chemical perspective, from elemental perspective, than the other PGM metals, because it starts reacting from lower temperatures, which makes it ideal for hybrid motors. And hybrid motors obviously is gaining market share in most places, in most markets. And so longer term, the demand for rhodium will continue growing relative to that of the other PGMs, while it's very supply constrained.
All right, let's leave it there, gents. Thank you so much for your time and sharing your insights with us this evening. That's all for Stockwatch today. Thanks to our guests, Jean Pierre Verster from Protea Capital Management and Drikus Combrinck from Capicraft. Up next, the close.